There are two numbers that will completely change how you think about retirement. Not the number your financial advisor gave you, not the number you saw in a headline. Two specific numbers that, once you understand them, make the entire retirement planning conversation feel like it finally makes sense. And here's what's strange. Almost no one talks about both of them together. Most retirement advice circles around one big round milestone, and in doing so, misses the actual mechanics of how wealth works. So let's fix that. For decades, $1 million has been the number. It's clean, it's aspirational, and it has been repeated so many times by so many advisors, financial magazines, and retirement calculators that it feels like mathematical fact. Save $1 million, retire comfortably. But here's the part most people miss. That number was never really derived from a deep understanding of how compounding works or how withdrawal psychology actually affects behavior in retirement. It was derived from a rule of thumb. Specifically, the 4% withdrawal rule, which was introduced by financial planner William Bengen in 1994. Bengen's research was genuinely good work. He looked at historical market returns and found that a retiree withdrawing 4% of their portfolio annually, adjusted for inflation, would not run out of money over a 30-year retirement in most historical scenarios. $1 million times 4% equals $40,000 per year. Add Social Security and you have something livable. On paper, it works. In practice, something more complicated happens, and that's what we're actually here to talk about. The first number that changes everything is not $1 million, it's $250,000. Charlie Munger was famous for saying that the first $100,000 is the hardest. He called it a critical milestone and urged people to scrape and claw to reach it by any means necessary, because after that, money starts to do more of the work. He was right, but also slightly early. At $100,000, compounding is real, but it's still modest. Assuming a 7% annual return, which is a reasonable long-run assumption for a diversified equity portfolio, roughly in line with the historical average after inflation adjustments, a $100,000 portfolio generates about $7,000 in investment growth in year one. That's meaningful, but if you're contributing $500 a month, which is $6,000 a year, your contributions are still doing almost as much heavy lifting as the market is. You're still, in a very real sense, mostly relying on your own labor to build wealth. Now, think about this. At $250,000, the math begins to shift. That same 7% return generates $17,500 in investment growth in year one. If you're still contributing $6,000 annually, your contributions now represent only about 26% of your total annual gain. The market is doing nearly 3/4 of the work. Something has fundamentally changed. You are no longer primarily a saver. You are now primarily an investor, and that distinction matters enormously, both mathematically and psychologically. At $500,000, the shift becomes dramatic. 7% on $500,000 is $35,000 in growth. Your $6,000 in contributions is now less than 15% of what your portfolio is earning. You could stop contributing entirely, and your portfolio would still grow by nearly 6 times what you're adding each year. This is the moment most retirement literature glosses over because it's uncomfortable to say out loud. After a certain point, your savings rate matters far less than simply staying invested. The behavioral challenge of staying invested through volatility becomes the primary job. The math has already taken over. This is where things start to change for how you should think about retirement timelines. If you're 45 with $250,000 saved and you never contribute another dollar, that portfolio at 7% annual growth becomes roughly $967,000 by age 65. Add 2 decades of even modest contributions, and you're well past $1.5 million. The acceleration is not gradual, it's exponential, and exponential curves feel flat until they suddenly don't. Most people psychologically experience the early years of saving as grinding because they are, but they misinterpret the later years as simply more of the same grinding, when in reality, compounding has already quietly taken over the engine room. The Federal Reserve's Survey of Consumer Finances shows that the median retirement savings for Americans aged 55 to 64 is approximately $185,000. The average, which is pulled up by high earners, is closer to $537,000. What that data actually reveals is that a massive portion of Americans are approaching retirement before reaching the $250,000 inflection point, the threshold where compounding becomes genuinely dominant. They're still in the phase where their contributions matter more than their returns, and that's a structurally different financial situation than being on the other side of that line, even if the dollar figures look similar on paper. Now, you might be thinking, okay, but $250,000 is still just an accumulation milestone. It doesn't tell me when I can retire. You're right, that's the second number. The second number that changes everything is not $1 million, it's $750,000, and here's why it matters more than the round figure most people fixate on. Let's do the actual withdrawal math, because this is where the psychology of retirement gets complicated in ways that financial calculators don't fully capture. If you retire with $1 million and follow the 4% rule, you withdraw $40,000 per year. The average Social Security benefit as of recent data is approximately $22,800 annually, or roughly $1,900 per month. Together, that's about $62,800 per year in retirement income. For a lot of people in a lot of places, that is a genuinely comfortable retirement. Bengen's research supports it surviving 30 years in most historical scenarios, so the math works, mostly. But here's what the math doesn't account for. Most retirees don't actually use the 4% rule the way it was designed. Research by Kitces, one of the most rigorous thinkers in modern retirement planning, has shown that retirees consistently underspend relative to what their portfolios could support. Fear of running out of money causes people to withdraw far less than 4% in down markets, live more anxiously than their actual net worth warrants, and in many cases, die with far more money than they needed. The psychological pressure of watching a portfolio balance fluctuate when you have no labor income to replenish it is genuinely stressful in a way that's hard to fully appreciate until you're living it. This is why the second number isn't just about math, it's about where the withdrawal math starts to interact with psychological security in a meaningfully different way. It's $750,000 with a 5% withdrawal rate, slightly above the traditional conservative guideline, but well within ranges that historical data has supported over 20 to 25-year retirements. You're drawing $37,500 per year. Add Social Security's average of $22,800, and your total income is $60,300. That is essentially equivalent to the $1 million scenario. The difference in lifestyle is negligible. The difference in required savings is $250,000 and potentially 5 to 7 additional working years. Now compare that to the $500,000 scenario that many Americans are actually facing. At 5% withdrawal rate, $500,000 generates $25,000 per year. Add Social Security and you're roughly $48,800 per year. That's a meaningful income, and for many people with paid-off homes and modest expenses, it's workable. But it comes with considerably less margin, less ability to absorb a major medical expense, a poor market sequence in the first 5 years of retirement, or a longer than expected lifespan. The psychological weight of that narrower margin is real, and it causes behavior changes, more anxiety, more conservative spending, a reduced sense of freedom even when the math technically works. Here's the part most people miss about sequence of returns risk. It's not the average return over a 30-year retirement that determines whether you run out of money, it's the order of those returns. A retiree who experiences a major market decline in years 1 through 3 of retirement is in meaningfully more danger than one who experiences the same decline in years 20 through 23, even if their lifetime average returns are identical. This is why the size of the portfolio at retirement isn't just about income math, it's about buffer. It's about having enough assets that a bad sequence doesn't permanently impair your standard of living before the portfolio has time to recover. It's $750,000, a 25% market decline, which is roughly what happened in 2022, and is not a rare event historically, costs you $187,500 on paper. That's painful. But if you're withdrawing $37,500 per year, your portfolio still has roughly $562,500 working for it, and a recovery period of 5 to 7 years brings you back. At $500,000, that same 25% decline leaves you with $375,000. Your annual withdrawal of $25,000 represents 6.7% of that remaining balance, which is a rate that historical data does not support well over long time horizons. You are now in a structurally fragile position, one that requires either reducing spending or hoping the market recovers quickly. That's a different retirement than you planned for. And this is why that number matters, not because it's a magic threshold, but because it represents the approximate level at which withdrawal math, Social Security, and portfolio buffer combine to create a retirement that has real resilience. Below it, you're managing risk tightly. Above it, you have breathing room. The jump from $750,000 to $1 million in terms of actual quality of life is far smaller than the jump from $500,000 to $750,000. Yet the cultural conversation about retirement almost exclusively celebrates the $1 million milestone as the meaningful one. Now, you might be thinking, what about inflation? What about healthcare? What about the fact that the 4% rule was designed for a 30-year retirement and people are living longer? These are legitimate questions, and they actually reinforce the argument rather than undermine it. Longer retirements do increase the risk that a fixed withdrawal rate depletes a portfolio. Healthcare costs do rise faster than general inflation. And yes, a more conservative withdrawal rate, 3.5% or even 3%, might be appropriate for someone retiring at 60 rather than 67. But notice what adjusting for those factors actually does. It makes the $1 million target feel more reasonable, while simultaneously making $750,000 with smart planning and Social Security optimization feel viable. It does not change the fundamental insight that the specific number matters less than understanding the mechanics underneath it. Social Security optimization is itself a tool that most people underuse. Claiming at 62 versus waiting until 70 results in a benefit difference of roughly 76% in monthly income. Someone with a moderate earnings history who claims at 62 might receive $1,400 per month. The same person waiting until 70 receives approximately $2,400 per month. Over a 20-year retirement, that's a difference of nearly $240,000 in cumulative benefits. For someone with $650,000 saved, the decision of when to claim Social Security is every bit as financially significant as having saved an additional $100,000. And yet the conversation almost always focuses on the portfolio balance. What emerges from all of this is a picture of retirement that's actually more nuanced and in some ways more hopeful than the simple $1 million benchmark suggests. The real retirement equation has three components: the compounding acceleration point, which happens around $250,000 and determines how powerful time is working on your behalf; the portfolio resilience threshold, which sits around $750,000 and determines how psychologically and mathematically secure your withdrawals are; and Social Security optimization, which is a separate lever that can add tens or hundreds of thousands of dollars of effective wealth without requiring any additional saving. What makes the $1 million number problematic isn't that it's too high. For many people, saving more is always better. It's that it's presented as a binary. Either you hit it or you haven't succeeded. That framing causes people who are at $650,000 or $700,000 to feel like they're failing when the actual math of their retirement is likely sound. And it causes people who do hit $1 million to feel finished when the more important question, how you manage withdrawals, when you claim Social Security, how you handle the behavioral challenge of watching balances fluctuate in retirement, is still entirely ahead of them. Here's what the research actually shows about retirement satisfaction. It isn't strongly correlated with having a specific account balance. It's correlated with having a clear, understood income plan. Retirees who know exactly where their money is coming from each month, from Social Security, from a portfolio withdrawal strategy they understand and trust, from any pension or rental income, report significantly higher well-being than retirees with equivalent or even higher balances who lack that clarity. The number in the account matters, but the understanding of how that number translates to sustainable, predictable income matters more. Compounding is a slow promise that delivers dramatically. In your 30s, it feels abstract. In your 40s, it starts to feel real. In your 50s, if you've stayed invested, it starts to feel almost unfair in the best possible way. The math isn't working for you like a steady engine. It's working for you like an engine that keeps getting bigger the faster it goes. The tragedy isn't people who don't reach $1 million. It's people who don't understand that $250,000 at 45 is fundamentally a different financial situation than $250,000 at 55, because one of them has a decade of compounding acceleration still ahead of it and the other doesn't. Time is the variable that no financial article puts a number on because it's uncomfortable. The honest version of retirement planning acknowledges that the best decisions are made early, that compounding rewards patience more than it rewards income, and that psychological clarity about how to draw down assets is as important as the size of those assets. The $1 million milestone isn't a lie exactly, it's just incomplete. It tells you what to aim for without telling you why the number works, which means it can't tell you what to do when you're close but not there, or how to behave once you arrive. Two numbers: $250,000, where compounding begins to outpace your contributions in a meaningful way, and $750,000, where withdrawal math and Social Security combine to give most people a retirement with genuine resilience. Understanding both of those, really understanding them, mechanically and psychologically, is worth more than any single target you've been given, because the goal was never to accumulate a number. The goal was always to stop trading time for money at the moment of your choosing with enough clarity about the math to actually enjoy what comes next.